Okay, welcome to the beginner and small account trading group for Thursday, August 9th, 2018. And I'm looking for an email here for just a second. Okay, good, ready to go. The disclosure is that Aramir is not a broker-dealer or securities investment advisor, and I am not a broker-dealer or securities investment advisor, so we're not making any specific trade recommendations here in this session. Everything that you see in here in this session is for educational purposes only. Options involve risks, and you will always trade at your own risk. And past performance is not indicative of future results. So with that, you can read the rest of the disclosure, and I'll get to my screen. So I guess sound check. You guys hearing me and seeing my screen okay? Let me know. Okay, thanks. All right. Today, I got a couple things I want to talk about. I had an email from Scott who suggested a couple of topics about the Greeks, kind of as a follow-on to the Greek explanation that Tom did on Tuesday, or maybe it was a week ago, I can't remember now. He did an excellent introduction to the option Greeks. So I want to talk about the Greeks a little bit and how they apply to your trading. And I want to go over two of the covered calls briefly. And then if there's time, I want to talk about broken wing butterflies versus standard butterflies a little bit and try to explain why the strategies are different for those two different types of butterflies. Okay, and any questions you have as well. So let's get right into it. I get my microphone adjusted right. Okay, sorry about all the noise. So let's look at the covered calls for a second here. Two of them in particular. Dominion Energy is this first one, and we've talked about this one in here several times over the months. I started this trade back in March, and I've done covered calls several times, and I've gotten a dividend, and I've probably gotten another dividend, but I haven't booked it into here yet. And we're up to $414 if the current call should expire worthless. But here's the thing. These are August 17 calls at the 65 strike. Well, if we go look at D, it's at 71.03. Those calls are very much in the money, and so I'm certain to get exercised and lose my shares if I stay in these calls. At the same time, if you look at the 65 calls, they have 2 cents extrinsic value left. Okay. If there was a dividend X date tomorrow, I would be certain to be assigned on these and I would not get the dividend. But it isn't tomorrow, it's September 6th. And they pay 83 cents. That's worth getting if I can get it. But the problem is these calls are so deep in the money that I can't roll them very easily. If we try our standard tricks, where I would sell a diagonal, I would buy back my August 65 call and sell further out in time and higher in strike. Let's just say I wanted to go to 72.50 to stay out of the money. I can't do it for any kind of credit at 1 month. If I go out to 18 January, which is the furthest month out, I still can't do it for any kind of credit. I'd have to pay $4.15 debit. If I did that, that would take out $415, or put me back to zero. On this position. However, I'd have my new strike price at 72.50, which is out of the money, and I wouldn't be at risk of being assigned. So at the same time, since they're out of the money and they have extrinsic value, I wouldn't lose these when ex-dividend date comes up on September 6th. So that's one thing that could be done, even though it'll reset my profit in the trade. But if I'm intending to stay in this for a long time and keep the shares, that's probably what I should do. But let's look at a couple other possibilities. If you look at the strikes, the ones that I'm short are between there, let's call it $6.10 is what I could buy them for. Now, if I go out a month at the same strike, I can sell these for maybe $6.20, $6.30. Okay, so I can actually get a credit if I stay at the same strike. Let's model that. It says I would get about 20 cents credit. Now, should I do that? Well, I could, and I could bide my time until X date comes along. But even now, they have 22 cents extrinsic value, and the dividend is higher than that, so I would be certain to be assigned on the X date, possibly before, if I did this. How about if I went out to January 19 at the same strike? Now I can get a decent amount of credit, and the extrinsic value of these options is 62 cents. It's still less than the dividend. I would be certain to be assigned on X date. So what to do? What is the right thing to do here? I could do nothing and lose the shares. I'd kind of like to not do that. What I'm leaning towards doing is simply maybe next week sometime or pretty soon when this gets, if this stays really low, I probably ought to do it about now. That's pretty low extrinsic value. I think I'm going to buy these back and not be in a position until, in an options position until September 6th. That way I wouldn't be short any options. I wouldn't get assigned. I would get the dividend. And then on September 7th or maybe September 6th, I can go back into selling covered calls. Because I want to keep the shares, and because I have a good basis on the shares, which is 67, is that right? Yeah, 68. I think that's what I'm going to do. I'm going to just close this option position. It'll show this at a loss. It'll be about $200 loss, okay, which is going to be actual realized loss, but I'm still in the shares. I'll get a dividend, and then I can do covered calls again. So those are a bunch of possibilities you can do when you're in this situation. This one essentially got away from me. What I should have done is when it went above about 66, I should have rolled these calls and I would have been able to probably do it for credit had that happened, but it got away from me and now it's too far away on too stable of a stock to get any premium to roll these out in time and up. So I think that's what I'm going to do. The other one I wanted to talk about was SO, Southern Corporation. It's in a similar situation, but not as bad. If you look at SO now, it's at 46.81. Okay. My calls are at the 45 strike, which means I'll be certain to get assigned, and this one goes X next Friday. Okay, so I have to do something real soon if I don't want to lose these shares. And again, I'd kind of like to keep them. I've got a good basis and they have a good yield. I kind of like to keep these and collect the dividends. So I will need to do something or else I'm going to lose them. So let's look at the same choices. The 45 calls are quoting at about $1, let's call it $1.85. I have two of them, so I could buy these back for about $360. And I'd be minus 240 or something net on this for a while. But I could sit it out, get the dividend, and then right away collect premium by selling more calls. That's probably what I'm going to do. However, a couple things to think about. My basis on this stock is under the strike price of 45. I built it that way on purpose so that if I did get assigned at 45, I will make 41 cents per share on the stock, as well as the premium from selling the calls. That might be a reasonable thing to do too here. If I was willing to lose the shares, I should just let them go, and this is going to come out at a profit of 113.50 plus 82, so it'd be somewhere around $200 on an $8,000 investment made back in June. That's not too bad of a return. I could do that. The other thing that could be done is roll these, and I believe there's some credit here, so let's take a quick look at the diagonal roll on these. If I wanted to get out of the money, I'd have to go to a 47 strike, so let's just set that to 47. And it's a debit if I only went a week, but let's start going further out in time and see if we can find a credit. Here's September monthly. Okay, nothing there. Here's November monthly. Last debit, but still no credit. Here's February 2019. Not great, but I also know that if I did this, I would avoid assignment, and if the stock goes down even a little bit, I can roll these strikes down and in instead of up and out and continue to collect premiums. So I have an adjustment up my sleeve if I need to do it. Let's go one further. If we went all the way a year and a half, that must, oh wait, let's see. Okay, that strike must not exist, so let's find out what strike does exist a year and a half out in the leaps. They're 5-point strikes, so I'd have to go all the way up to 50 if I did that. And I still can't get a credit, so I definitely wouldn't do that. That's way too long to wait for no real savings. So what am I going to do? I think I'm going to buy these back, wait for the dividend next week. It's only a week away, and then sell more calls. I think that's what I'm going to do on this one, so that I can keep the shares. Okay. So I just wanted to point out what some of your choices are when you're in a situation like that. The first one I'm in is a worse situation because my basis is 68. I really don't want to let these go for 65 because I'll lose $2.99 per share on the shares, which I'll still come out having made a little bit of money, but I'd really like to make more money than that, and I'd really like to keep these shares for the dividends and the dividend growth. So next week, maybe we'll look at these two again and see what I end up doing. Any questions about the covered call rolls? These are things that when you read about a covered call strategy, or even if you read the book, and there's several books out there, and I've read a couple of them about covered calls, don't really talk about what I just mentioned very much. You're never out of choices, and some of them may be good choices, even if you're in a bad situation where the stock has gone up so much and it's in the money so much. So I wanted to be sure and point that out. Okay. Let me look at my notes and shift gears here to the next topic. Which is the Greeks. Let's talk about the Greeks for a few minutes. Let me get Thinkorswim up. Let me clear this out, and let's go to SPX. SPX, right there. Okay. Now, Tom did a good introduction to the Greeks last week, and I'm not going to go over a basic introduction, but I want to expand on it a little bit and point out a couple of things that you may not think the Greeks do for you. So let's dive right into that. The first one is, let's say that I sell an August 17 put in the SPX that's at the money? First of all, you can see it on my screen. First of all, what should the delta be of an at the money put? Anybody know what? You should know what that is. It's going to be just about, oh, let's see what, I got a message. About 50. Yes, Craig, you're exactly right. It should be very, very close to 50. So the at the money is going to either be the 28.55 or the 28.50. And we look at the delta here, it's 44 to 50. So it's going to be really close to 50 for the at the money. Same with the calls. They should be pretty close to 50. And here we are. We have the closest one is exactly 50. Okay. So let's, oh, I don't know. Let's sell one of these. You wouldn't do a uncovered put in the SPX because it uses $58,000 in margin for one contract. That's just not worth it, even if you get $1,260 premium for doing it. But it'll make my example here. Thinkorswim has calculated, here's the Greeks of the position, and somebody's unmuted, so I'm going to mute. There we go. Okay. Thinkorswim has calculated all these Greeks according to its model. These are calculations, they're not exact. In fact, there are no exact numbers, there are only models. So different models can be slightly different, and especially in the weeklies and the last few days, some of the models don't calculate very well. Some of them break down, so that what you see isn't really what it is. But my point is, you don't know exactly what it is anyway, so the model is the best thing you can do. Now, if you run this simulation forward and SPX doesn't move, what should happen to the delta? It shouldn't change much. It's still at the money. You know, every day I go forward, it's moving a little bit, not very much. But I want you to make note of the gamma here. Watch what the gamma does as I do that. It's 201 on this day. I go one more day, it's 246, 347, went up a whole point. The closer you get to expiration, the higher the gamma gets. At the money options have the highest gamma of all, and closer to expiration have the highest of all of those. I'm going to talk about gamma a little bit, but this is what we kind of commonly refer to as the gamma explosion late in the trade. It happens with butterflies, it happens with any options that you have. And in most cases, with butterflies and income type trades, it's a bad thing. So without getting into a technical definition of gamma, here's what you should know about gamma. If you're an income trader like I am, and like Low Trip and M3 and all these trades are, credit spreads, parking, gamma is bad. No gamma is good. The lower the gamma, the easier it's going to be for you to manage your position. Okay, now let's see. Question. Dan calls gamma the Delta manufacturing machine. I love it. I actually haven't heard that, but I love it. That's great, because that's exactly what it does. Gamma is a measure of how much the delta changes for a 1 point move in the market. Okay, so if SPX should go down by 1, the delta, which currently is 54, might be 58 on this day at that strike, or when we're near the money like this is. Okay, that's a huge difference. What that means is you will have a practically impossible time managing your delta the closer you get to expiration because of the gamma explosion. Let's say that your trade is set up such that when you have more than positive 10 delta or negative 10 delta, you adjust the position, right? And if it's late in the trade, your gamma could be 6 or something, let's say. I've seen this happen. The butterfly gamma will be -6. That means there's a 2 point move in the SPX in one day will force you to make an adjustment. Whereas if your gamma was, let's say, 0.2, 0.2, or negative 0.2, the 2-point move would make your delta change by only 0.4 or so. That alone probably won't drive you into making a delta adjustment based on delta. Okay, I hope I'm explaining that well, but this is the reason it gets really hard to manage by delta late in the trade. Now, I want to back up for a second, then we'll come back to where I just ended. But let me back up for a second because I got ahead of myself. What we're looking at here is the gamma of this option. Okay, when you have a butterfly on, let me just pull up one of my road trips as an example. How about this one? This is an October road trip that I actually have on live. Look at the gamma here, it's negative 0.02. October's pretty far out. Further out options will have less gamma. And we're also not near the money because basically the money from shorts anyway is right here, which is 110 points away from the market. So those two factors contribute to being low gamma. But here's my point. TOS is showing us the gamma and the delta and the theta and the vega for the entire position. It's a composite of the individual gammas for each of the legs of the butterfly and each of the legs of this condor that I added onto it. And of the 4 lots here and the 2 lots here, add all that up together and it should come to these numbers that you see here. So when you're looking at a position that's more than one option in Thinkorswim simulation like this, then you're looking at the overall delta and gamma and Greeks for your entire position. Which is really nice because if we're managing by delta or vega or anything else, here you are, here's the numbers. Again, know that these are models. Option view is going to show a different delta because it can use a different model. Thinkorswim will change if you change it to the smile, volatility smile. And there it is. We change this to volatility smile. We've got a new one. Watch my Greeks when I change it to that. Let's see if I can't fix it. Okay. So without it, it's 3.53, and we have 13.8 theta and 109 vega. And with it, we've changed quite a bit. I mean, this change alone, in some cases, might be enough to make you do a delta adjustment. So you are dependent on whatever model you're using. That's why typically when we build a strategy, we build it using a certain setting for the model, and that's the setting you should use when you are following that strategy, because that's what it was built on. I'm going to put this back so I don't get all messed up. Now, let's run the simulation forward to 2 weeks to expiration. October 5th. Watch the gamma. It's 0.02. Now we're going to be much closer to expiration. It's 0.45. Okay? Still relatively small for a position like this. This is a 4-lot position with 12,000 in margin. Well, now let's go forward day by day. Let's go forward 7 days. So now we're going to be 1 week to expiration. 0.98, not too bad. It's not going to be too bad because we are out of the money still on these, but even so, the gamma is rising the closer you get to expiration. 2, 3, 4, 5, 6, 7. Also note that on expiration day, gamma must be 0, as must be vega, and theta, and delta. They all go to 0 eventually. But before they go to 0, this got up to about 1.04, which could be a factor in your delta calculation on this trade if you were managing by the delta. All right, so does that make sense? I think I beat that to death, but I hope that makes sense. Let's see. Somewhere hidden in the bowels of TOS is a setting for the interest rate in gamma. Do you know where it is? I think so. Let's see. You can No, I thought it might have been there. It isn't. Okay. Interest right here. This rho is the interest rate used in the Black-Scholes calculation. Rho is one of the so-called Greeks that is an output. So if I change this to, let's change this to 15%. It changes my P&L and all my numbers. The Vega went down. I'm pretty sure went down. I didn't look at it. These may not have changed very much, but this is how you can model the effect of changing interest rates in Thinkorswim. I think that's the answer to your question. The bottom line is nobody talks about rho very much because it doesn't make very much difference, and in the current low interest environment, it doesn't matter very much either. If interest rates really were 15%, we would probably start thinking about rho a little bit in our modeling, in our calculations. So I'm going to be sure and put this back to current because I don't want to leave it at 15%. Okay. Thanks, Scott. A good question. How would you list the importance of the Greeks? So, Road Trip is not managed by the Greeks as such. There aren't rules or guidelines that say when delta gets to this, then you need to make an adjustment. He does it more based on the graph and various settings of the graph. I do look at the delta, and so I would say delta is probably the most important one to look at when you're doing a road trip type or a BWB type trade. Theta is what it is, and it usually takes care of itself. I don't worry about theta very much. I don't worry about gamma. I don't stay in these to the end, and they have relatively low gamma anyway because they're out of the money. I do look at Vega, and we talk about ratios of Vega to delta or Vega to theta, and you can come up with certain ranges or guidelines of that ratio. And that's probably more important than looking at the individual numbers. Also, the delta to the theta ratio. Now this is bad. Let me go to today. Or the inverse, theta to delta. 12 to 2, ignoring the sign of it. That's about 6 to 1. That's good. If it gets below maybe 2 to 1, 2 theta to 1 delta, again, we don't use that in the road trip so much, but in standard butterflies and M3s, I use it all the time. And 2 to 1 or less is not good. You should do something to fix it if it gets to be in that range. So I'd say if you had to pick one, I'd say delta is the most important Greek to watch when you're doing BWBs or most other kinds of trades. Sorry. Let's see, another question. Mitigate the effects of Vega on the BWB. Is Vega exposure just the nature of risk for BWB? Yes, it is. For all income style trades, they are negative Vega trades. And that's the nature of some of the risks that you're taking when you're doing income style trades. So what it comes down to is if you could neutralize your Vega, I'm getting off track here, but if you could make your Vega be 0 and keep it there, and if you could go into the graph and look at the Vega of the graph, if it will do it, come on, Thinkorswim, what are you doing? Not updating. Maybe you have to wait a minute because the market's closed. If you could make a trade, I don't understand why it won't do that. That's odd. That's kind of strange. Thinkorswim should be doing that. When you change this here, it should change the graph to show the delta versus the underlying price, or Vega versus the underlying price. Not doing it today. That's very strange. Okay. Well, what I was going to try to point out is let's refresh. Let's go to another and come back and see if that matters. There we go. Okay, thank you. Yeah, that worked. Even if I could neutralize it at the current point, what this has shown us is that as the market goes down, we're going to get hurt by Vega, even so. If you could do something to make this graph go positive as we go down, like the calendar would be, then you will have eliminated and even come to profit from your Vega or volatility risk. See if I can show you what that might look like by just modeling a calendar here. Apply a calendar. Uncheck everything else and see if the graph looks like I thought it would look like. Yeah. If I had just this calendar on, and here we are here, as the market goes down at least to a certain point, see how this is happening? I'm actually profiting from Vega here because it's positive Vega. I'll make that be, Thinkorswim, okay. Well, let's make this be a 10 lot just so it'll show it better. Yeah, it doesn't really show it better, but see how flat this is versus curving down like the butterfly was. The butterfly. This is kind of bad, and this is what's hurting you when there's a big drop when you have negative Vega. And there's a second order Greek that is called that, and I can never remember the name of it. It's Vanna. Okay, yeah, Vanna is the slope of this Vega line, which is negative here. So this trade would have negative Vanna right now, and that means you're going to get hurt by volatility rise if the market drops. Whereas a calendar has more positive Vanna, or at least flat for a while, don't get hurt so much by it. Let's see. MB says I'd suggest watching delta per thousand of risk as well as theta per thousand. Yeah, that would be another way to look at it. We did that, and I go back to P&L here, if it will. That's very strange. It must be because it's after hours and Thinkorswim is running slowly. Here our total risk is 12,370 on this trade, and your delta is -2. So you divide that out, that would be a number, and you could watch that number. That would make sense. I have the same dates in the calendar trade. You must mean different dates because I used August, and you're right. I should probably have used. We'll change it to October, and it should look differently. Uncheck everything else, and we look at the graph. And we change it to Vega, and we make it update. All these things we have to do. Yeah, it made it possibly curve up more for a while. Okay, but I've gone way off track, down away from where I wanted to go on this, so let's get back on track a little bit. Here's the next thing I want to point out. Let's get this road trip back up here. And let's get back to P&L. Now, most everybody thinks that at the current price, if my theta is 12, then I make $12 a day from theta, which is options price decay. day by day. And if it was a higher number, like it will be in the future, I would now be making $18 a day. And that is true on the surface, but you need to look deeper than that because the market isn't going to stay here. And so let's say that you have a theta of 12 today, right here, and tomorrow the market goes down, let's say, to 2840. That'd be 13-point drop, goes down to here. And if I put a price slice there and I go forward one day in my simulation, it says my theta would be $14.06. Now, everything else being equal, how much theta did I make overnight or in that one day? Think about that for a minute. How much theta did I get? Did I get $12 or $14 in theta? Well, the answer is not what most people think. I have seen many, many, many people expect, well, I got $12 that day and now I'm going to get $14 this day. But that's not correct. The theta that you get, and getting theta is actually probably not a good description, is essentially this $14 if the market had gone here, other things being equal, like delta and volatility and stuff not changing. And if the market had gone to here, your theta was $17. And if it had gone to here, your theta was $2. You don't collect the theta from where we were and take it with you. Okay? So if the market stayed here, you would. But if the market goes up to here, you only really would have gotten about $2 theta. Now, in a move like that, I know delta and vega and other things would greatly overpower a $2 difference in theta. In fact, you might not even be able to measure how much theta you got. But it doesn't go with you. You don't collect it and take it with you. So this is one reason why your P&L can go up and down quite a bit unexpectedly when you say, but I have a lot of theta, I should be getting this much theta per day. It depends on where you are, and the theta that is built into the trade, or the decay of the options that's built into the trade, is that as of where the market is when you measure it. You didn't collect anything here and take it with you over to here. Okay. I saw somebody who said, well, if I got $12 theta today and 14 tomorrow and 21 the next day, that all adds up to $50 in theta, but my P&L is only up $30. Yeah, everything else overpowered it and you didn't take it with you. So I wanted to point that out and make sure you keep that in mind. It doesn't affect things very much. Theta will take care of itself in the end. It's more important that you don't lose too much from delta or vega that blows your trade, at least when you're doing this kind of a trade. Okay, let's see. In the upper right-hand corner, the question, right under on demand, there are 3 horizontal lines. Yes, clicking on them will allow a screen refresh. Oh, okay. This first menu or this second menu is, I guess, I don't know. I can't even make that go away now. So here's the first menu. Reset. Oh, so is that what it is? If I click reset, what's that do? I don't even know. Reset. Oh, okay. Resets everything, however, but it will refresh. So I have to change this back to high positions again. And I have to scale my graph again. But okay. I've never known what that is, so thanks for pointing that out. Okay. Now I want to switch to option view here for a second because I have to show what I want to show next about delta and gamma. So I built this example. I set the date to a week ago, Thursday, August 2nd at 13:30, which is a half hour after the close. So it's going to use closing prices. And I sold an option that's pretty close to at the money at that time for $12.50. Okay, that's the trade that I'm modeling here to use as an example. Now, it has relatively high gamma for a one contract trade. Why? Because it's at the money and it has very short time to go. It only has 9 days to go to expiration. And I picked it that way on purpose. But it also has positive delta of 46, which makes sense because it's close to the money, so it would be close to 50 delta. It's positive delta because we're selling a put instead of buying it. And if you look at the graph, it looks a lot like put credit spread graph does. Barking trade, put credit spreads, things like that, even almost cash secured puts and covered calls. We're not seeing this, but unlike a put credit spread, we have unlimited risk to the downside all the way down to zero. But that's not important for what I want to show you here. So here's the question. This dashed line is the T+0 line today. If the market goes up 13 points to 2840, and I'll just move the wand, I call it the wand here, over to 2840 right here, and in that little green box down here, you can read what the Greeks are going to be according to the model at 2840. I should write this down because we're going to need to remember it. So P&L is option view. I can call it 494 P&L and delta is 3198. Okay, I'm going to write that down. And I'm going to write down gamma, negative 1.01. Okay. So here's the question. This is your trade. You're looking at it today, or on August 2nd, and you kind of want to get an idea for how much your P&L will be if the market goes up 13 points to 2840. Well, what I do and what most everybody does is they look at the graph and they say the model says it's going to be it's going to be $488. So let's go forward today and see what it actually does. Now, I said 13 points because I already know it went up 13 points the next day, so I cheated. But we're going to make our point here. Here we are, we're up 598. We're up a little more. And now we look at the T+0 graph, and it says we're up 598 approximately, if I could get it exactly right. But look at our delta. It was 45, if I remember right, yesterday, and now it's 30.31, and our gamma is 1.07. So keep that in mind for a second. Let's go back to yesterday, or the day of opening. If you think about if you think about delta, then for every point the market goes up, this is saying the P&L would go up by $46.07. And that's kind of true, but not literally true. If the market goes up 13 points, then this delta number would say 46.07, and our P&L would be 598, plus some theta, which you don't take with you, but it would be somewhere in the range of this. So let's add in $72.86 more of theta. And I get $671 is kind of where you should be at 2840 one day from now, based on those numbers, if they work that way. This is my whole point, however, they don't work that way. Delta doesn't stay constant as the market moves, and it varies essentially by the amount of the gamma and by the amount of the second order derivative of the gamma, which is called speed, I believe. There's a Greek called speed. It's the second order derivative of gamma. And nobody ever thinks about speed, including me, but it's there. So what happened? Why did our delta go from 46 down to 31, 30, 31? It's because of the gamma. Now let's think about this. So the market went up 13 points. What's 13 times 1.13? Because it's negative, and that this gamma number tells me that your delta will go down approximately 1.13 per point of the market moving up, and I get minus 14.6 on the delta. If I subtract that from 46.07, I get 31.38, which is almost exactly what it is. That's the effect of gamma. Now, it's even not quite exactly that so much. Note that as we go up, look at gamma itself changes, and that's the speed measurement. And so the first point that it went up, gamma took out 1.14 delta. The second point it went up, it was probably more like 1.12. And by the time we had gone up to 2836, it was down to 1.06 per point. And you can see if we had gone up, clear up into here somewhere, our gamma would be down to not affecting our delta at all because we're so far away from the money. Now, let's think about this to the downside for a minute. This is what really hurts you on late trades with gamma. If we went down 13 points, we already had about 45 positive delta. It's getting more positive as we go down by 1.14 or a little bit less for each point because this gamma falls off here as well. But 13 times 1.14 is, again, about 14 or 15 points. This gamma is going to go from 49 to 63 or 4, which it shows right here in the model. It gets bad really fast on the downside. That's my point. And this is what hurts parking trades, put credit spreads, anything that has this kind of risk hurts a lot to the downside, because if you stay late in the trade and get close to expiration, gamma really kills you. Okay. So one of the things I like about road trip versus M3s is that most of the time throughout the life of the trade, gamma is lower than it is in M3s because we're further away from the money, and even further out in time in the early stages of the trade. That lower gamma throughout the entire trade makes road trip easier and a bit safer, you might say, than M3, and that's one of the things that I really like about road trip. Okay, so that's about it for what I wanted to say. Remember that you don't take your theta with you, and that your delta as the market moves, whoops, yeah, do this. As the market moves, your delta changes by the effect of gamma point for point. And if gamma gets large, then your delta has large changes for small changes in the underlying price of the market, which makes it hard to manage your trades. That's my whole point, and I wanted to try to explain a little bit about gamma and delta and theta. Okay. All right. Let me just, before I stop, I have 10 minutes. I won't probably be able to do what I wanted to do, but let me just talk about broken wing butterflies for a minute here. Let's just look at a plain old broken wing butterfly, and let's look up another one that's not a broken wing butterfly, but is balanced butterfly. So I'm going to go 60 up and 60 down, so it'd be 2680. Where is it? There it is. Okay. Now we're not concerned about prices or Greeks here. We're just going to look at the graph, so I'm going to make the graph kind of big. And here is a broken wing butterfly, and here is a balanced butterfly. Why is it balanced? Because the legs are, the flat parts are equal. Down 620 here and down 620 here. This is a balanced butterfly. Now, I'm going to make these be a little closer to expiration too. So let's go to, how about, let's assume these were 31 August trades. Okay, this I think will make my point. Yeah, this will make my point. Right now we're looking at the balanced butterfly. Where is the peak of the T plus 0? Well, it's right here. Let's look at the broken wing. Where is the peak of the T plus 0? It's about here. In relation to the tent, where is it? It's further up in the tent, right? The broken wing peak is about here at 2730, and the balanced peak is about here at 2691, 40 points lower. This is one of the things that dictates that if you're going to trade balanced butterflies, you have to have a different strategy than if you're going to trade a broken wing butterfly. Because in a balanced butterfly, if we get way out up here, you're starting to have a bad looking graph and you're starting to have high delta numbers, okay, which means that the graph is falling off very steeply. Whereas in a broken wing, you have less delta at the same point because the peak of the T plus 0 is shifted upwards. Now, I guess I'll leave it to say today that the road trip strategy of doing reverse Harveys, you've probably heard of that, and lots of other things that they do are built to take advantage of the fact that the peak of the T plus 0 line in the basic butterfly is somewhere up in here, maybe even sometimes clear as far as out in here somewhere. That's why you can do the reverse Harvey, which is selling these and buying some of these and get credit enough to make your trade work. But if you were doing a balanced butterfly, a reverse Harvey, these are going to be further away from the peak of your T plus 0. This might not be the thing you want to do. You might want to actually take some of these and roll them up or down because you're closer to the peak of your T plus 0. And also, if the market goes down, well, in this balanced butterfly, you have nothing much to worry about because you've got increasing T plus 0 as the market goes down up to a point, and then you get past that point, maybe right here, what you do is you add another butterfly at different strikes. You double it. You put a double butterfly on. I'll just move them all down 25 points. 55. Now you have a, you still have a balanced butterfly, but it's a double butterfly now. It has two different peaks. We've condorized it by flattening out the top of this. And essentially what we've done is we've moved the width of this tent closer to the peak of the T plus 0. We've gone in the direction we want to go. Give us more peak if it keeps going down. Well, if you had a broken wing butterfly and it had gone down that much, same thing, you have, at least in this example, maybe it's not a great example, but I can accentuate the example by doing this. Now, if we've gone down to the same point, you're already in trouble. You're past the peak of the T plus 0, you're falling off, you're losing money. So you wouldn't let it go this far in a broken wing before you did something. And then what do? Well, you might need to roll it down because we don't generally double these. You might need to get it hedged so this doesn't tail off so much. It's kind of more flat as we go down. These are all differences that each strategy is built to take advantage of. And one of the reasons it's built that way is because of the difference in the peak of the T plus 0 line. Okay, that's all I'm trying to say on that. I think I will stop there, but thanks guys for coming in. We had, how many did we have? We had 13 or 14 today. And I feel like it's been hard to explain some of this stuff today. I hope I did a good job. Think about it, work up some graphs, and see that, and you'll see that everything I pointed out is true. Work up some paper trades and follow the expected theta per day. And in the paper trade, make it a 100 or 200 lot trade. Make it really huge so you have some big numbers. It's just a paper trade. And see if things work the way that you might have thought they worked or work the way I explained it today as far as theta goes. And I think that'd be a helpful exercise to help you understand how all these things work. Okay. In Scott's original mail, he asked some questions about more psychological things about trading, and I should talk about those. Maybe I'll try to remember to do that next week or sometime soon. And otherwise, have a good week and happy trading. We'll see you guys later. Thanks for joining.